Welcome, this is Jason Martin. Today is November 2nd, 2020. Wanted to give you guys a special market update as we go into the elections. Let me share my screen here so you can see what we're looking at. I want to cover today a couple of main things. One, we want to look at historical market returns as we're going into elections. And then we want to look at kind of what we believe is a bigger concern, which is the second wave of coronavirus. And then finally, we want to prepare you guys and just let you know, inform you guys as to how we are preparing the portfolios as we go into the end of this year. So let's hop right in here. First, as we go historically, when you look at elections and what we're looking at here in this chart, showing it's going back to 1936, and it's looking at the average S&P 500 price performance during a presidential election year. So this line, this vertical line right here represents the election. Everything before that are the market returns before that. Everything after is the market returns after. What I want to focus on here is the 1 day after, 1 week after, and 1 month after. And so the light shaded blue area is if the incumbent party won, and the dark blue area is if the incumbent party lost. So as you can see here, 1 week afterwards, on average, the market's down about 1%. 1 month after, the incumbent party, if they won, it's still down about 1%. If the incumbent party lost, it's slightly positive. And then if you see here by year end, if the incumbent party won, you're about flat. If the incumbent party lost, you're up about 2%. And in both cases, 6 months after and 1 year after, market returns are higher. The reason I point this out is that as we've been telling everyone as the last 2 market updates that we've had, is that we don't believe the presidential election, the results of the election, are significant in terms of market performance. Elections are important, I understand that, but in terms of historical market performance, whether it's been a Republican president or a Democrat president, it's been a difference of about 0.2% on average over time in the markets. So that is not a major concern long-term as we look at how the market performs coming from or going into elections. Now, what we're more concerned about on a short-term view is that if we go into some type of recount or the election results are disputed. So what we're looking at here on this chart is how the markets performed after the 2000 election between George Bush and Al Gore. And so this is looking at it from election day till December 12th after the Supreme Court decided the election. And so as you can see, during that time, during its worst time, the market was down about 8%. And after the whole thing, or during the whole thing, during that whole time frame, the market was down about 4.24%. So I think this is the bigger concern from a short-term perspective, is that what if the election results are disputed and you go into this kind of recount scenario? That can provide some short-term volatility. But notice the key word I'm using, and that's short-term. We shouldn't make large, portfolio adjustments based off of something that's short-term. Now, as we'll go into more in a little bit, we have already positioned the portfolio defensively going into this time frame, more so based off of, we believe, a second wave of coronavirus is coming and has already started, but more so than the election. But at the same time, we're prepared for volatility around the election. So let's look at what we believe is the bigger concern right now, which is the second wave of coronavirus. As you can see here, this is looking at 4 different charts, 4 different regions of the world, and this is a chart on deaths of COVID-19. So as you can see, going into the last month or so, Europe has had a huge spike of deaths and is by far the highest area out of all these main regions. Actually, the United States, out of these 3 regions, is the lower one. But at the same time, if we flip over here to cases, you can see at the same time, Europe is leading in terms of the most cases, but the United States is also reaching new highs from the highs it had back in the summertime. And so that is a reason to be slightly concerned because as what's happening in Europe in the last couple of weeks, there has been some shutdowns. Now, what we've been saying is that we believe in the United States, the shutdowns will be different if we have them again. going into kind of the next couple months. And if the second wave of coronavirus continues to increase and the cases continue to increase, as we've seen recently in Europe, they've been different than the first set of shutdowns. The first set of shutdowns was an all-out nationwide, everyone stay at home type of shutdown. We don't believe we're going to have that. That hasn't been the case in Europe so far for the small shutdowns that they've had. And we believe that's not going to be the case in the United States either. So while we do believe it can slow down the progress of the most recent economic rebound that we've been experiencing, we do believe it'll be different if we have certain types of shutdowns or mandatory masks, or maybe closures of restaurants and theme parks and things like that. It won't be as bad as the prior time, in our opinion. And so, just in summary, market volatility around the election is short-term in nature, and it's best to focus on the long term when investing. So, sometimes people get really concerned around election, and we understand it's all over the news. That can drive fear, which can drive you to potentially want to go cash. We don't believe that is a good idea. In fact, there are a lot of cases where the markets could go up a lot. In fact, the last election was very uncertain, and right after the election, the market went up a lot. So there are time periods where you could have the market go up right after an election. And so we don't believe you should ever go cash really for any time frame, just 100% cash in a portfolio. Now, that being said, we do believe that there is more of a concern with the second wave of coronavirus. But at the same time, pandemics typically don't last much longer than a year. So there will be an end to coronavirus at some point, whether there's a vaccine or whether it just runs its course like every other pandemic historically. And so, I just want to reassure everyone that we have positioned the portfolios in our last 2 times that we've rebalanced our portfolios, we positioned them more defensively. Okay. And so the way we've done that is we've gone more defensive by owning less stocks and specifically selling off some of the kind of the U.S. growth stocks, which we believe are more overvalued. We've increased gold. That was not the most recent rebalance, but back in June, we increased gold. And we've also increased more safe haven bonds. So safe haven bonds would be ones that aren't as risky. So all that to say, we just want to let everyone know that we are prepared for the elections, and no matter what the election brings, we're ready for that. Obviously, we'll be studying the markets like we do, in order to find ways to better protect our clients' accounts, and at the same time, look for opportunities to help them grow. So I hope this helps, and hope everyone stays healthy, and take care.